Hello everyone. So in this video, we'll be discussing the paper Money and Banking, which is a general elective paper, economics. It has 8 questions. You are supposed to attempt 5. Every question carries 18 marks. So now, starting with the questions. The first part of the question is, you are supposed to explain the concept of deposit multiplier and currency multiplier. So in the class itself, I have mentioned about how the H theory of money supply works, where currency plus reserves is the monetary base and reserves get multiplied and they get multiplied to finally have demand deposits. So this is the total money stock. So reserves are of two types. First, required reserves, which is mandated by the RBI. So it can be in the form of SLR, which banks have with themselves, or CLR, which banks are supposed to put with RBI. CLR doesn't give you any interest rate. And then there could be some excess reserves as well, which the banks might be holding with them. But in case of excess reserves, the banks would lose out on the interest rate that they could have given with those reserves if they have put them into loans. So this is the opportunity cost. So the money multiplier in this case is M equals to C plus DD upon C plus R. Dividing everything by demand deposits, we have CD plus 1, CD plus RR plus ER or ED. So this is the complete money multiplier. Okay. Now, where CD is currency to demand deposit ratio, RR is required reserves to demand deposit ratio, ED is excess reserves to demand deposit ratio. And since all of them would lie between 0 and 1, so this value is greater than 1. So we can find that the value of the multiplier is greater than 1. Now, the monetary base is C plus R, which is equals to CD into D plus RR excess reserves into D, which is nothing but CD plus RR plus ED into D. So the deposit multiplier is monetary base into the multiplier, which is, this is the demand deposit multiplier. Okay. Now this is the deposit multiplier and we are supposed to find the currency multiplier as well. So if deposits are increasing by this rate, then currency would be increasing by the increase in the demand deposits multiplied by the currency to deposit ratio. Okay, I hope this is clear. Now coming to the second part, asymmetric information lead to financial crisis. I'll be discussing this later in this video. We will be talking about moral hazard, adverse selection, and then we'll discuss about Lemon's market. Okay, now coming to question 2. So in this question, it is given that required reserve ratio is 10%. I'll just note it down. Answer to first part, required reserve ratio is 10%. Excess reserve ratio is 5%. Desired currency to deposit ratio is 5%. Okay, so excess reserve ratio is 0.05. Currency to deposit ratio is 0.25. Now they are asking, how does an open market purchase of 5 lakh change deposit, currency holdings and money stock? Open market purchase of 5 lakh. So if there is an open market purchase, this leads to increase in the monetary base. Now we need to find what the impact of this on deposits, currency holdings and money stock. With the help of the formula that we have already found earlier, we can see deposits would be impacted by this much. So deposits would be change in monetary basis plus 5,000 plus 5 lakh, and the deposit multiplier is 0.25 plus 0.1. Substituting these values, we will get this. So this is 1 by 0.4 times 5 lakhs. So this is coming out to be 125, 1, 2, 3, 4. 12 lakh 50,000. So by 12 lakh 50,000, the deposits would rise. Similarly, if you want to find the currency multiplier, by how much the currency is changing, so this would be CD upon change in currency holdings would be CD plus RR plus ED into change in monetary base. This is nothing but 0.25 times 0.4 into 5 lakh. So we can solve this, right? Okay, I'm not doing the calculation, but I hope you can solve it. And the change in the total money stock would be change in D plus change in C. We can just add it up because we know money stock equals to demand deposits plus currency. So change in money stock would be equal to change in demand deposit plus change in currency. Okay. Now, how does your answer change if the required reserve ratio rises to 20%? Now, since the required reserve ratio has increased, required reserve ratio is now 0.2. In the initial case, it was 0.1. So the value of the multiplier would fall. The value of the multiplier would become, the value of the complete multiplier would become CD plus RR plus ER. So this is 1.25 upon 0.25 plus 0.2 plus 0.05. So this is 1.25 times 0.5. Okay, this is the value of the complete multiplier. The value of the demand multiplier deposit multiplier would be 1 upon CD plus RR plus ER, which is 1 by 0.5, which is coming out to be 2, which is less than this term. 2 is less than 1.04 because this is 2.5. So what we can see is the deposit multiplier is falling because this is falling. Change in currency would be lower as well because this multiplier, this value has, the denominator has increased. So similarly, the change in the money stock, which is change in demand deposits and change in currency, would be lower. Okay, now moving to the B part, you need to differentiate between base rate and the marginal cost of fund based lending rate. How are these rates useful in monetary transmission? I hope you all are aware of what monetary transmission is. Monetary transmission works, so this is answer 2, in a manner when the RBI reduces the repo rate. This leads to cheaper credit being available to the commercial banks, and these commercial banks further reduce their lending rate, and this to the general public, and this leads to more investment. So this is how the monetary transmission works. Okay, now I'll tell you in this types of question how you are supposed to write. We'll write the factors. We are supposed to differentiate between base rate and marginal cost of lending rate. Now we can tell about in which time period they came into force. So the base rate came into July 2010, whereas the MCLR came into April 2016. Now if you're discussing about flexibility in deciding the cost of funding, which is a very crucial point. So in the base rate, the flexibility was given whether to choose average cost or marginal cost or a mixture of both or some blended form. Whereas in MCLR, it is being clearly stated that the banks are supposed to use the marginal cost principle in determining their cost of funds. So since this they have given this much discretion, so this leads to a more opaque system. Now discussing about the formula which is used to derive, this is the discretion of the commercial banks in case of base rate, whereas in MCLR, RBI has prescribed a specific formula. Okay, and it was observed that when it comes to rigidity, base rate was more rigid. Okay, more rigid, whereas marginal cost of lending rate was more sensitive to change in the policy rate. So this would be a better policy tool if they want to look for transmission of monetary policy. Okay, now coming to our next question, we are done with question 2. Explain the legal framework that allows the Reserve Bank of India to function as a central bank. So in this case, first we can write about the 1934 Act, where it was stated that the purpose of the bank is to ensure that there is adequate credit supply and to issue the notes. Then in 1949, it was nationalized. Now with the developing scenarios, it is taking care of the foreign exchange reserves as well, and Deposit Insurance and Credit Guarantee Corporation, they are taking into they are regulating it as well. And then current scenario, you can write about the MPC, Monetary Policy Committee. Also you can mention about the preamble of the 1934 Act, which states that it's the duty of the RBI to make sure that there is credit supply and other factors which are crucial for the growth of the economy. Okay, we are done with third A. Now we are supposed to go to page 4. Okay, so money supply in India can be affected by changes in monetary base and or the money multiplier. So since we have already found that the complete money multiplier is 1 plus CD by CD plus RR plus into monetary base. This was the total money demand and at equilibrium, this should be equal to money supply. So money supply can be influenced either by change in monetary base or by change in the value of the multiplier. You can derive this and show. I hope this is clear. Now, okay, so we are done with third question as well. Let's talk about fourth question. What is reserve money? List the sources of changes in reserve money. And we have already discussed that you will be doing this by your own because this is very basic stuff. So I'll do question 4, first part, which is about reserve money. So reserve money is nothing but net monetary liabilities of the central bank. Net monetary liabilities of the central bank. But if we are talking about from the asset side, reserve money equals net RBI credit. So the credit that the RBI has given to the government, this includes both state and central government, then RBI credit to banks, then RBI credit to commercial banks, then net foreign exchange assets of RBI. Then we have currency of government. Okay, we have currency of government, which is a liability for it. So government currency liabilities. Minus net non-monetary liabilities. Okay, you need to remember this because it is highly expected they will ask this question. Okay, Now coming to, so list the sources of changes in the reserve money. These are the sources which can lead to change in the reserve money. Now since, okay, I am expecting you to do B part of the fourth. Now coming to fifth A part, differentiate between the prime lending rate and benchmark prime lending rates. So in this case, prime, it is more fruitful if you draw a table. You can tell before what, so prime lending rate is the minimum rate that you are charging the most credit worthy borrowers. So you can tell before this how the interest rate was regulated. You were supposed to, before, in the till the 1980s, how the interest rate was regulated, that banks were supposed to lend to a specific sector at a particular interest rate only. Now you can draw a table because this shows a bit more sophisticated. Prime lending rate, benchmark prime lending rate. So this is for most creditworthy borrowers. And benchmark PLR was, so now this rate, the prime lending rate, kept on varying. The spread and the prime lending rate kept on varying between the different banks. So every commercial bank had a different prime lending rate. The spread was different. So this was introduced so that for a particular sector, a benchmark is set for the prime lending rate. So all the banks are supposed to follow this benchmark instead of choosing their own interest rate. But the problem with this is, the problem with benchmark prime lending rate is that most of the actual lending took place below this rate. Since actual lending took place below this rate, it was difficult to assess the impact of this rate on monetary transmission. Okay, this was rigid and it kept on varying from bank to bank. So the monetary transmission impact of change in interest rate was difficult to assess. Okay, now coming to B part. So it is not merely the number of instruments that is important, but the number of instruments exerting independent effects on the target variables. Explained in the context of monetary policy instruments and targets. Okay. Now, this was answer 5B. We have studied about the Tinbergen rule, which states that if you have two targets, if you have two targets, then you need two policy instruments to achieve it. Similarly, if you have n targets, you need n policy instruments to achieve those targets, and if the impact of these targets are independent. Okay, now what we have studied is mostly, suppose this is the aggregate demand, this is aggregate supply. Here we have output, here we have prices. Now the central bank themselves have only one policy tool. They have different policy tools, but any of the policy tool would impact the aggregate demand only. So suppose our target is this level of output to be produced and this level of prices to be achieved. So either if the central bank increases, okay, I'll draw the graph. If they want to achieve the output target, so they will reduce the aggregate demand to here. We can see the output target is being satisfied, but this is the corresponding price level. So if they want to achieve the output level, they have to forego with the price level. On the other hand, if they want to, I'll draw this with the red. If they want to achieve the price level, so they will increase the aggregate demand to this AD2, this is AD1, and here the price level is being achieved, but the output level, we are not able to achieve it. It is higher than this. Okay, so it depends upon how many targets you have and how many policy tools are there with you. Okay, I hope this is clear. Okay, now coming to 6th day, explain the problems of lemons in stock and bond market. I'll explain this at the end of the video. Okay, we are supposed to solve this. Yeah. Explain how the expectation market hypothesis and segmented market hypothesis are different version of the preferred habitat hypothesis. Discuss with example. Okay. Okay, now I'll give you a brief example first. Suppose you have got two job opportunities. Suppose in KPMG and JP Morgan. Expectation hypothesis would state you are only concerned about the salary. You will prefer the job which is giving you a higher salary irrespective of what the location or the work culture is, right? The segmented hypothesis states that you would have a preference. Either you would prefer, suppose most of us would prefer JP Morgan over KPMG. So it states that irrespective of what other factors are, you will prefer JP Morgan over KPMG any day. And the third, the preferred habitat hypothesis would state that although you prefer JP Morgan over KPMG, but if they pay you some extra premium in the form of different perks or salary, you might be preferring KPMG over JP Morgan. So in case if you go for KPMG, they'll give you the salary, and since you wanted JP Morgan as the first priority, they'll compensate you by paying some premium to you. I hope this is clear, and I'll try to explain this with the help of our bonds market and expectation market as well. So the interest rate on an n-year security would be alpha n. This shows the term premium. This might be the premium to overcome the cost as well. And this is the expectation hypothesis according to which the long-term interest rate is determined. So it has incorporated the term premium and the rational expectation hypothesis as well. Okay. Now coming to 6th P, we are done. 7. Okay, explain the differences between M3 of second and third working group of RBI. I don't expect you remembering this. So they have given 5 options in this case. So we can remove this as well. Or you can just have an overview. You can search it on the Google as well. Now the part B is from the same chapter that you suggested that it was easier. So you are doing this on your own. But it makes sense because as information, so this is related to asymmetric information only. Coming to part C. What is the yield curve? Explain the condition in which it can be downward sloping. Okay. It was answer 7, part C. So yield curve is a graphical representation which shows the relationship between interest rate and term to maturity. So suppose the interest rate for 1 year is 5. So suppose if you're talking about a government security or treasury bill, for 1 year treasury bill, the interest rate is 5%, and for 2 years, suppose it is 10%. So this curve, and for 3 years, it is suppose 14%. So this curve is the yield curve. Now they are asking in which particular case can this be downward sloping. Downward sloping means this is term to maturity, this is interest rate. Downward sloping means you are expecting that interest rate for a higher duration bond or the government security would be falling in the future. So this suggests that you are skeptical about the economic growth of the economy, and there are some recessionary conditions in the economy. Okay, there are some recessionary conditions in the economy and you are skeptical about the growth rate. So yield to maturity, the yield curve can be negatively sloped as well. Okay, according to the expectation hypothesis, the yield curve can slope upward, downward and be a straight line. Explain. Expectation hypothesis. The expectation hypothesis states that it is D part. So suppose we have a security for which after n year it will get matured. So this can be the interest rate on this, or the yield on this can be written as the yield, the interest that you will get on a 1 year security now, the expected interest rate that you will get on the 1 year security in the next year, and similarly till this is the expected interest rate in this after 2 years that you will get on 1 year bond. So now if the expectations are same only, suppose I is 5 right now and you expect E1I equals to 5, that is the next year the interest on 1 year bond would remain 5 only, E2I as 5, which means after 2 years the interest rate on 1 year bond would remain 5% only. And similarly for other factors. So suppose then the yield curve would be a flat line, because 5 plus 5 plus 5 n times by n would give you 5 only. And if you are expecting the interest rate on the 1 year bond in the future time period to fall, then IN would fall, which means the yield curve would be downward sloping. And similarly, if you are expecting the interest rate on the 1 year bond to be higher in the future, then IN would be higher, would be higher, and hence yield curve would be upward sloping. Okay, now coming to we're done with this. Okay, now we are supposed to list 3 monetary tools that RBI can use to achieve its monetary targets. We know about repo rate, we know about reverse repo rate, liquidity adjustment facility, which is done to if there is a mismatch in day-to-day transactions, and then CLR, CRR, cash reserve ratio, SLR, you can write many of them. Marginal standing facility rate is also there. Okay, now moving to question 8, A part, explain the expectation hypothesis. So we have observed that they are asking a lot of questions on the expectation hypothesis. How could future interest rates be forecast using the expectation hypothesis? Okay, now suppose we have 1 year bond, answer 8A. Presently the interest rate is I, and we are expecting for this in the next year the interest rate would be. So suppose we want to know in the next year what the interest rate should be. Sorry. Whereas for a 2 year bond, we know the interest rate is I2. So if the investor is indifferent between investing in 1 year bond for 1 year and then again in the second year, the expected return, his expected return from investing in 1 year bond would be 1 plus I into 1 plus E1I, and the amount that he is initially investing. So this would become 1 plus I in the first year, and in the second year, if he reinvest in a 1 year bond with the expected interest rate this, so this would be his total return. So he would be indifferent if from a 2 year bond he gets the same value, which is, so if he is investing in a 2 year bond with interest rate I2, will get this value. This cancels out, And if we know the value of I and I2, we can find the value of expected value of 1 year bond. So expected interest rate of 1 year bond at the end of 1 year. Okay, I hope this is clear. Okay, so we are done with this. We are left with this. What are the intermediate targets? Critically examine the rate of interest and monetary aggregates as intermediate target. Okay, I have done this very extensively in the class as well. So this is answer 8B. So suppose this is money stock and this is interest rate. So if we have an interest rate target, suppose in this case we have an interest rate target. This is the money demand, this is money supply. So if the money demand increases towards the right, we are far away from the interest rate. So RBI, what RBI can do is they can increase the money supply. We want to get to the same interest rate. So this is the target, right? So in this case, they will increase the money supply to this so that we are back at the same level of the target. So this was M0, this is M1. Although this money stock has increased, but we are still at the target level of interest rate. Similarly, if we are talking about money stock target, monetary stock target, or money supply target, in this case what we have is this is the monetary target. This is money demand, money supply, and this is interest rate. Now, if money demand increases or reduces, we can draw for various cases. The new, we get MT1 and I1. Now to get back to the money target, the bank can reduce the money supply so that it intersects at this point and we are back to the our original monetary target. You can draw different cases to explain it. Okay, now we are done with B part. The C part is derive and explain the following: deposit multiplier, currency multiplier, and complete money multiplier. We have already discussed this. Okay, now talking about asymmetric information. I'll give you an example of a second-hand car market. I'll discuss the second-hand car market. Asymmetric information means that there is different level of information among the two parties. So in case of a second-hand car market, what we have is the sellers are better aware of the quality of the car, whereas the buyers don't have the exact information what seller possesses. So the cars are of two type in this case: good quality, bad quality. Good quality sellers, so the sellers who have good quality cars, they would be charging a higher price for sure. But since buyer doesn't know which car is bad or good, and suppose they are charging price 100, the bad quality ones are charging price 80. So the buyers don't know what the problem or the quality of the car is, so they'll tend to buy the cheaper good. Okay, so they'll tend to buy the bad quality cars only, and this is called lemon problem. That is, they tend to buy the bad quality cars only, and this happens due to adverse selection. And then there is another concept of moral hazard. So suppose if you go to a bank and get a loan from it, and the bank says, so you go to the bank and you say that I want a loan for a business purpose, But once you get the loan, you spend it on your marriage or some extravagant, so okay, or on some unnecessary things. So in that case, once you have taken the loan, your actions don't match what they were supposed to be. So that leads to a problem of moral hazard. Because if we have taken life insurance, we tend to drive faster. So this is a moral hazard problem. Okay, so I hope this was clear. And if you have any doubts, you can leave it in the comments.